Hello. I just flew in from New York where I spent the day with Nick Murray and my fellow Spartans. He's been a mentor and a leader and a fantastic guy for my entire career, more than 25 years. He started way before that, but it's fantastic. And we're going to talk a little bit about the day with Nick.
Awesome. I'm excited to hear all about it, Patrick. Welcome to Cup of Bull. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial
Cheers.
Planning. Cheers. All right, Patrick. So kick it off. Tell us some of the highlights of the day.
So it started out with a room full of folks in the Marriott Marquis in Times Square with Nick Murray. His daughter, Karen, has organized this event. His granddaughter was there greeting, his son's there taking some photos. It's a family affair. Nick Murray has been a force in our industry for 50 plus years. He's 82 years old, I believe, and this event was called The Last Waltz. I've been to it a few times. I've read absolutely everything he's ever written, including every issue of his newsletter for the last 25 years. So it's always a joy to be with him and to hear his wisdom. And I just had a great day on Friday in New York City.
Awesome. Well, I just thought of a story that I thought I'd enjoy sharing on this, which is the day that you and I met. You were in the lobby of the Merrill Lynch office when I was introduced to you, and you were on your way to the airport to go to, I believe, the 2018 version of the Nick Murray single day conference. And I like to think that I maybe impressed you since I knew who Nick Murray was and I had read his stuff, and he had been on a podcast that I'd listened to recently as well. So I have enjoyed Nick for many years myself. And even though I didn't get to go to the event, he has been a tremendous addition to our line of thinking and a lot of the decisions that we make on behalf of our clients.
Absolutely. Yeah, he's a force and a little bit of inspiration for a lot of things we do and the way we talk about some of the behavioral investment psychology, if you will. Behavioral Investment Counselor was one of his books. And I know you and I have both read all of his books. Before I got in this business, I read The Excellent Investment Advisor, and this was back in 1999 and 2000. And I've reread that book a few times along with everything else he's come out with. So the day basically opened up with him acknowledging a few people in the room, a lot of the multi-generational families that, father, daughter, mother, son, three boys that work for one of the advisors. And there's just a lot of folks in the room like me that had been there a few times. And so just acknowledging some old friends. Then he did a bit of a recap of history and restated some of our Spartan philosophies, the Nick Murray Spartans that kind of follow his teachings, if you will, and how that works. So it was pretty awesome. And then ran through some history.
Awesome. So one question I have to get started that I'm sure came up as part of the day. So when the spaghetti hits the fan and the market is down, what should people do? I'm sure he talked a little bit about some historical downturns that have occurred, and I guess thinking of present day as well.
Yes. So one thing that was awesome is the timing has just worked out to where the 25 years of the newsletter is also the 25 years of my career. So he recapped my whole financial planning life by hitting the 7 highlights, or you could call them lowlights of what's gone in the market. Ran through a little bit of history, which, when I started, the late 90s were the tech boom. A lot of these tech company valuations got really high and the market had just gone on a tear really from 82 to 2000. And the first 3 years I was in the business, the market went down 50%. So down, 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 and he went over what had led to that and a little bit of the history. And one fascinating thing that I'd not heard before, and he loves to make fun of the media a little bit, financial media. And he said the brain dead editors at one of these magazines, had actually named Enron 6 years in a row as the, best, most revolutionary company. Enron was part of that debacle and blow up of the tech boom. So that was the first big downturn of the 7. Was my first 3 years in the business, bam, down. And then he hit the other highlights, which some of these we forget about, that were bear markets, 20% plus, events, European debt crisis. The big ones were the global financial crisis that most of us have studied and read and, seen all about. And I know you experienced, 34% or 57%. And that was right at the moment where I was starting at Merrill Lynch, and bam, pretty big downturn. Then the most recent big one, is when you and I spent a lot of time together, and actually the tail end of it launched our firm, almost 5 years ago. So that was down 34% in 33 days. And the pandemic, COVID was pretty massive. So covered some history and threw in his wisdom and some insights into the future and kind of what to do about all these things. So he really challenged us that this is not new. Every single year it should be expected. The market goes down an average of 15% every year. And we have communicated this to our clients, and it's just amazing how quickly, the game plan changes and people forget. And so when you look at the last 25 years, which a lot of our clients, including myself, like that's been our investing lifetime, and gave the stat of like what happened over those 25 years. Well, these 7 major things happened. The market halved 3 times, down 50% essentially, and had major things happen in the world. But yet, the great companies of the country and the world have continued to thrive and grow and come out ahead. So optimism is the only realism.
One of the framings that I've always thought Nick does such a great job of, that's so important to remember, is when we are investing in equities, what we are doing is buying great companies. And we can't control when these downturns are going to happen. We can't control what the downturns look like, and we can't avoid them. But when we own great companies, we can be reassured in the fact that those great companies are run by great individuals who are incredibly intelligent, extremely hardworking, and their number one priority is to help whatever business that they're working for navigate the crisis of the day. And the market has always come back. We don't know when it's going to happen. We don't know how it's going to happen. But whenever we do have one of these downturns, we know that the market is going to come back. And I won't be able to cite the specific stats. I don't know if you have them in your notes, but when you are an owner of great companies over time, one of the framings that Nick does a really good job of is just showing what does inflation look like over time. And then when you own good companies, what does the dividend yield on those great companies look like? What is the growth of the value of the investment look like? And it's always many multiples over a as long as you give yourself enough time, it's always many multiples higher than the rate of inflation. And so our challenge as investors is being able to control ourselves behaviorally and emotionally when those downturns occur, but the reward is being able to participate in that many multiples of growth over enough time.
So I know I haven't shared this with you yet, Michael, but one of the things he kind of wrapped up his history of these 7 major downturns was the example of money, like what happened in real time with real money, and reminding us, a lot of the older guys in the room, that like, how it felt as advisors, how it felt as clients to be in the depths of that. And just a reminder that like this happens, and this is where it's valuable to bring our experience and insight and the proper kind of moves when this happens. So if you invested $100,000 the night before things went down and really kind of had that 50% pullback in 2000. So you really, say, look, you had the worst timing. Like you started right here. But if you had good behavior and never bailed out on any of those traumatic, real moments that people felt, and really just hitting that home, a phrase that I've heard him say many times, that we fight against, right? This time is different. Yes, this time is different every time, but it's not in the sense of, what's going to happen. Well, things work themselves out a little bit differently. But if you put $100,000 in the day before, right, and you fast forward through those 25 years and all that history, all those big pullbacks, all that stuff, compounded over that time, just letting the 100,000 go, what was the number? Pretty fascinating. Not adding any money, just letting it roll.
How much?
750,000.
So instead of this time is different, the rephrasing, this too shall pass.
This too shall pass. You've been trained well, young Padawan. This is the way to be in the financial behavioral world is, this time is different. No, this too shall pass. It's the way to do it. And really, we are more and more convicted as we have navigated all these things, and including this year, right? 2025. What happened? We had a president get elected, tell us everybody he's going to do these tariffs. And Nick Murray was very funny the way he kind of pokes fun at our politicians and our financial media and all those things. But he was, the tariff man comes in, talks about all these tariffs, and sure enough, the media in the country freaks out over these tariffs. And it was a real thing. It was like intraday, he gave the stat, I want to say 21.3% in 3 days. Like, bam, and we felt this. It didn't register as far as closing day as the downturn of 20 plus. It was 18.9, 19% this year, back in April, this happened, right? And if you didn't bail out, if you didn't have bad behavior, and you actually did the wise thing to rebalance, to add money, to do the right moves, what's happened? Well, it's rebounded significantly to this point in the year. And that's how you win, is have a plan, execute the plan, remove some of the emotion, have good behaviors, and follow the guidance.
One thing I'll add too, if you didn't react appropriately and you panicked out during that down period, when the tariffs were lifted, the market was up over 10% in one single day too. So the market being up 15% or so, call it right now, you would only be up 5% if you got right back in right after the market went up 10%, assuming you were able to make the right behavior at that point in time. So that's the other risk of ever trying to time the market, is you have to know when to get out and you have to know when to get back in, and nobody ever gets it right. And that's the risk, is you miss out on the big 10% day when everything all of a sudden seems better.
Yeah, I love his phrasing and his raw, kind of, when you're 82 and you don't have a filter and you can just say it how it is. He threw out some terms that were fantastic, and just, that there's going to be some issues coming. Instability on roller skates was one of the ones that stuck with me, and just the idea that what was it, that we've got some hideously over concentrated, positions. Well, true. What do you do about it? Rebalance, add money, have your kind of fully funded emergency fund, have these things in place, have a plan, have the expectation. I'm definitely convicted that, like we've always said, there'll be a red dot. There'll be another red dot. Every year there'll be a red dot. And what we should be doing, and when we have the next one, is add to capital, the great capitalist shareholders, add money to the right companies that are not hideously overconcentrated, and repeat until rich.
If we can look at the downturns as opportunities instead of the emotional like decline that we feel, and if we can position ourselves intentionally by having a good financial plan where you're going to be secure, you're going to be okay, it's much easier to look at the downturns opportunistically, and there can be great opportunity by leaning in, by rebalancing, adding money if you have it, doing smart tax planning moves when the market is down. It's a very difficult thing to do, to manage those emotions, and that's where a good financial partner can be helpful. But it can be it can take difficult times and make them great opportunities if you're able to do that.
Right, and he took it back to some of our rules of engagement. Is how everybody starts with a plan. You have to have a plan, and really making that fit with the client situation, knowing the clients and being there for them, and how important the relationships are. And I see that with my relationship with Nick over the years, and then with our clients, and how important that is to just have that connection and be in touch and be always updating and doing the right behaviors, updating the plan and executing.
Anything else on your list that you wanted to share?
It was just a good group. I spent time with a couple longtime friends there. One from Winfield, Kansas. I'll give a shout out that he's 78 years old. His wife couldn't make it this year. She's got some rheumatoid arthritis, and he and I shared a coffee after it was over, and then did a happy hour dinner with several of the guys, and just the common background. And it was an impressive group. There's a few things I'll rewrite my notes and get back with you. We'll have a little team debrief of some of this wisdom. And as usual, it was time well spent, and re-energized, re-engaged me on like what we need to be driving for.
So I'm going to change things up to finish it off. Instead of asking how you would like to wrap us up. How do you think Nick would like to wrap us up?
I know he's expecting red dots. All right. And so he will say, this time is not different. And he would say, this too shall pass.
Cheers.
Cheers.